Question 1. Which of the following is not a common characteristic of a protected cell captive (PCC)? A. It allows for separate legal structures within the same captive company. B. Each protected cell has its own set of financial statements and liabilities. C. All cells in a PCC are required to share the same board of directors. D. The assets and liabilities of each cell are legally segregated from other cells within the PCC. Answer: C. All cells in a PCC are required to share the same board of directors. Explanation: a protected cell captive (PCC) allows for multiple cells within the same captive insurance company where each cell operates like a separate entity with its own financial statements, liabilities, and assets, but it is still part of the same legal structure. However, each cell is not required to share the same board of directors. The flexibility in governance is one of the benefits of PCCS, where each cell can have its own distinct governance structure. Option is correct. PCCS are designed to allow multiple cells with separate legal structures. Option B is correct. Each cell's assets and liabilities are kept separate. Option D is correct. The segregation of assets and liabilities is a key feature of ease. Question 2. Scenario-based question. Mr. Taylor is the CEO of a newly formed single-parent captive insurance company in California. His company specializes in insuring the risk of its parent corporation and subsidiaries. The company is in the process of completing its business plan for regulatory approval. What critical step must Mr. Taylor include in the business plan before submitting it to the California Department of Insurance (CEI)? A comprehensive risk management plan outlining the risks the captive will assume and how it will manage them. B. A detailed history of the parent company's previous insurance claims. C. A promise to maintain a minimum premium threshold for the first 3 years. D. An agreement with an external auditing firm to handle the company's financial reports. Answer A. A comprehensive risk management plan outlining the risks the captive will assume and how it will manage them. Explanation: when forming a single-parent captive insurance company in California, the California Department of Insurance (CDI) requires a thorough business plan. This plan must include a comprehensive risk management plan which outlines the risks the captive will assume and the strategies it will implement to manage these risks. Option O is correct. The risk management plan is essential for regulatory approval and demonstrates how the captive intends to operate and manage risk effectively. Option B is incorrect. While claims history may be relevant, it is not a mandatory requirement for the business plan. Option C is incorrect. There is no fixed premium threshold required for approval. However, solvency and adequate capitalization are critical. Option D is incorrect. While auditing arrangements are important, the focus of the business plan is on risk management, not specific service agreements. Question 3. Which of the following best describes a key advantage of using a captive insurance company for risk management? A. Captives allow companies to avoid all state insurance regulations. B. Captives can be used to retain risks that are difficult or expensive to insure in the traditional market. C. Captives automatically qualify for federal tax exemptions on premiums. D. Captives eliminate the need for reinsurance in all cases. Answer: B. Captives can be used to retain risks that are difficult or expensive to insure in the traditional market. Explanation: one of the primary advantages of using a captive insurance company is the ability to retain risks that may be difficult or prohibitively expensive to insure through traditional commercial insurance. Captives provide companies with greater flexibility in risk management, particularly for high-frequency or high-severity risks. Option B is correct. Captives are often used to retain specialized risks that the traditional insurance market may either refuse to cover or charge excessively for. Option A is incorrect. Captive insurance companies are subject to both state and federal regulations, particularly in their domiciles. Option C is incorrect. While captives may have some tax advantages, they do not automatically qualify for federal tax exemptions. The tax treatment is dependent on the structure and compliance with IRS regulations. Option D is incorrect. While captives may reduce the need for reinsurance, they do not completely eliminate it. Reinsurance is still commonly used by captives to manage large risks or to comply with regulatory solvency requirements. Question 4. Which of the following is a typical characteristic of a group captive insurance company? A. It is owned by a single parent corporation that insures its own risks. B. It allows multiple companies with similar risks to pool resources and share insurance coverage. C. It is required to be domiciled in an offshore jurisdiction. D. The captive only provides coverage for one specific type of risk, such as workers' compensation. Answer: B. It allows multiple companies with similar risks to pool resources and share insurance coverage. Explanation: a group captive is a type of captive insurance company where multiple companies, often in the same industry or with similar risks, pool their resources to insure each other. This allows companies to benefit from economies of scale while maintaining more control over their insurance needs. Option B is correct. Group captives are designed to allow companies with similar risks to pool resources and share coverage. Option is incorrect. A single parent captive insures only the risks of its parent corporation, whereas a group captive insures the risks of multiple entities. Option C is incorrect. While group captives can be domiciled offshore, it is not a requirement. Option D is incorrect. Group captives typically provide broader coverage across various types of risks, not just one specific type. Question 5. Which of the following is the primary regulatory authority overseeing captive insurance companies in California? A. California State Treasury Department. B. California Insurance Commissioner. C. California Department of Financial Protection and Innovation, DFPI. D. National Association of Insurance Commissioners, NAIC. Answer: B. California Insurance Commissioner. Explanation: in California, the California Insurance Commissioner is the primary regulatory authority overseeing captive insurance companies. The Commissioner, through the California Department of Insurance, CDI, is responsible for ensuring that captives meet regulatory requirements for solvency, business operations, and financial transparency. Option B is correct. The California Insurance Commissioner has direct oversight over the regulation of captive insurance companies in the state. Option is incorrect. The State Treasury Department does not regulate captive insurance in California. Option C is incorrect. The DFPI regulates financial institutions, but captive insurance is primarily overseen by the California Department of Insurance. Option D is incorrect. The NAIC is an association of state regulators, but the individual states, including California, are responsible for regulating captives. Question 6. Scenario-based question. Mr. Davies is considering forming a new captive insurance company to insure the risks of his manufacturing business. His business is involved in high-risk production processes, and traditional insurers are unwilling to provide coverage at affordable rates. What is the first step Mr. Davies should take in forming the captive? A. Prepare a detailed risk management plan and submit it to the California Department of Insurance, CDI. B. Complete a feasibility study and submit it to the California Department of Insurance, CDI. C. Select an offshore jurisdiction for domiciling the captive. D. Sign an agreement with a third-party reinsurer to cover any claims above a certain threshold. Answer: B. Complete a feasibility study and submit it to the California Department of Insurance, CDI. Explanation: before forming a captive insurance company, it is necessary to conduct a feasibility study to assess the financial and operational viability of the captive. This study evaluates the risks to be insured, expected costs, capital requirements, and other critical factors. This must be submitted to the California Department of Insurance, CI, for approval. Option B is correct. A feasibility study is a crucial first step in the captive formation process and is required by the CDI. Option A is incorrect. A risk management plan is essential but is not typically the first step of the feasibility study as required first. Option C is incorrect. Jurisdiction selection comes after completing the feasibility study and understanding the regulatory requirements. Option D is incorrect. Reinsurance agreements are usually arranged after the captive is formed and operational. Question 7. Which of the following is a key advantage of domiciling a captive insurance company in California? A. Low regulatory oversight and fewer reporting requirements. B. Access to a well-established regulatory framework and access to the U.S. insurance market. C. Guaranteed tax exemptions on all premiums paid into the captive. D. Complete freedom from solvency and liquidity requirements. Answer: B. Access to a well-established regulatory framework and access to the U.S. insurance market. Explanation: domiciling a captive in California provides access to the state's well-established regulatory framework, which is designed to ensure financial solvency, fair business practices, and consumer protection. Additionally, California is a key state in the U.S. insurance market, providing captives access to a broad market base. Option B is correct. California offers a robust regulatory environment and access to the U.S. market. Option A is incorrect. California has strict regulations and reporting requirements for captives. Option C is incorrect. Captives domiciled in California are subject to state tax regulations and do not automatically receive tax exemptions on premiums. Option D is incorrect. Captives in California must adhere to solvency and liquidity requirements set by the state. Question 8. What is a common reason for a captive insurance company to enter into a fronting arrangement with a traditional insurance company? A. To avoid paying taxes on premiums. B. To provide the captive with access to the reinsurance market. C. To comply with regulatory requirements, particularly for licensing and claims handling. D. To eliminate the need for an insurance license. Answer: C. To comply with regulatory requirements, particularly for licensing and claims handling. Explanation: a fronting arrangement involves a traditional insurer issuing policies on behalf of a captive insurance company. The captive typically retains most or all of the risk, but the fronting insurer handles the regulatory requirements such as licensing and claims processing. This arrangement allows the captive to comply with local regulatory standards. Option C is correct. Fronting arrangements help captives comply with licensing and claims handling regulations. Option is incorrect. Fronting does not exempt a captive from taxes, it only addresses regulatory and operational issues. Option B is incorrect. While fronting arrangements can facilitate some reinsurance activities, they are primarily used for regulatory compliance, not direct access to the reinsurance market. Option D is incorrect. A captive must still meet licensing requirements even if it enters a fronting arrangement. Question 9. Which of the following best describes the purpose of a captive's loss reserves? A. To ensure that the captive can pay dividends to shareholders. B. To set aside funds to cover anticipated claims and losses. C. To pay for administrative expenses and operational costs. D. To maintain surplus capital for regulatory solvency requirements. Answer: B. To set aside funds to cover anticipated claims and losses. Explanation: loss reserves are funds set aside by an insurance company or captive to cover anticipated claims and losses that have occurred but not yet been paid. These reserves ensure that the captive has the necessary funds to meet its future liabilities. Option B is correct. Loss reserves are used to cover expected claims and losses in the future. Option is incorrect. Loss reserves are not used for paying dividends and they are allocated to future claims. Option C is incorrect. Administrative expenses are handled separately and are not part of loss reserves. Option D is incorrect. While solvency requirements are important, loss reserves are specifically for covering anticipated claims, not just for regulatory capital. Question 10. Which of the following is a requirement for a captive insurance company to qualify for the IRS 831? B. Tax election. A. The captive must insure risks exclusively for the parent company and its subsidiaries. B. The captive must have less than $1.2 million in premiums written annually. C. The captive must be domiciled in an offshore jurisdiction. D. The captive must have at least 5 policyholders to qualify. Answer: B. The captive must have less than $1.2 million in premiums written annually. Explanation: the 831(b) tax election allows small captives to exclude underwriting income from taxation, but the premiums written by the captive must not exceed $1.2 million annually. This is a significant tax benefit for smaller captives. Option B is correct. Captives making the 831(b) election must have premiums of less than $1.2 million. Option A is incorrect. The election does not require the captive to insure risks exclusively for its parent. It can insure risks for affiliated companies as well. Option C is incorrect. The captive does not need to be domiciled offshore to qualify for 831(b). Option D is incorrect. There is no requirement for a minimum number of policyholders to qualify for 831(b). Question 11. Which of the following is the most significant factor for determining whether a captive insurance company is eligible for the IRS 831(b) tax election? A. The captive must only insure the parent company's risks. B. The captive must maintain at least $5 million in surplus capital. C. The captive must write less than $1.2 million in premiums annually. D. The captive must be domiciled in a foreign jurisdiction. Answer: C. The captive must write less than $1.2 million in premiums annually. Explanation: the IRS 831(b) tax election applies to small captives that write less than $1.2 million in premiums annually. This tax election allows captives to exclude underwriting income from taxation, which is a significant advantage for smaller insurance operations. Option C is correct. The $1.2 million premium threshold is the key factor for eligibility for the 831(b) election. Option A is incorrect. The captive can insure risks for multiple affiliated companies, not just the parent. Option B is incorrect. There is no requirement for the captive to maintain a specific amount of surplus capital for the 831B election. Option D is incorrect. The captive can be domiciled in any jurisdiction as long as it meets the premium threshold. Question 12. What is the primary role of the captive manager in the operation of a captive insurance company? A. To provide capital to the captive. B. To handle the daily operations, including claims management, underwriting, and compliance. C. To assume risk for any claims that exceed the captive's coverage limits. D. To invest the captive's funds to generate returns for policyholders. Answer: B. To handle the daily operations, including claims management, underwriting, and compliance. Explanation: the captive manager is responsible for overseeing the day-to-day operations of the captive insurance company. This includes underwriting, claims management, ensuring regulatory compliance, and administrative duties. They play a crucial role in ensuring the captive operates efficiently and meets regulatory requirements. Option B is correct. The captive manager handles daily operations like underwriting and claims management. Option A is incorrect. The captive manager typically does not provide capital but manages the operations. Option C is incorrect. The captive itself assumes the risk and the manager handles the operational aspects. Option D is incorrect. While the manager may oversee investments, their primary role is operations, not investment management. Question 13. Which of the following would likely be the best candidate for forming a captive insurance company? A. A company with no significant risk exposure. B. A large company that is seeking to reduce its reliance on the commercial insurance market for unique or hard-to-place risks. C. A small business with limited capital and a need for broad insurance coverage. D. A non-profit organization looking to cover charitable activities. Answer: B. A large company that is seeking to reduce its reliance on the commercial insurance market for unique or hard-to-place risks. Explanation: a captive insurance company is most often formed by large businesses that want to assume more control over their insurance coverage, particularly for specialized or hard-to-place risks. Captives allow for tailored coverage and potential cost savings for companies with substantial insurance needs. Option B is correct. Large companies often form captives to manage unique or hard-to-place risks while reducing reliance on the commercial market. Option is incorrect. Companies with little risk exposure generally don't need to form a captive. Option C is incorrect. Captives are typically more suitable for large businesses rather than small businesses with limited capital. Option D is incorrect. Non-profits may use captives in some cases, but they are less common than for-profit companies. Question 14. Which of the following is typically excluded from coverage in a captive insurance company? A. Risks covered by traditional insurance policies. B. High-frequency, low-severity risks. C. Catastrophic events with low probability but high impact. D. Risks that are illegal or against public policy. Answer: D. Risks that are illegal or against public policy. Explanation: captive insurance companies, like traditional insurers, are restricted from covering risks that are illegal or against public policy. This includes risks associated with criminal activities or other illegal acts. Option D is correct. Risks that violate the law or public policy are excluded from coverage. Option is incorrect. Captives may provide coverage for many risks that are also covered by traditional insurers, such as property damage or liability. Option B is incorrect. Captives often cover both high-frequency, low-severity risks and more catastrophic risks. Option C is incorrect. Catastrophic risks can be covered by captives, often with excess reinsurance. Question 15. Which of the following is an example of an ancillary benefit of a captive insurance company? A. Exemption from all state insurance laws. B. The ability to issue its own insurance policies and contracts. C. Access to more affordable commercial insurance through reinsurance. D. Complete control over pricing and claims decisions by the parent company. Answer: C. Access to more affordable commercial insurance through reinsurance. Explanation: an ancillary benefit of forming a captive is the ability to access more affordable commercial insurance by purchasing reinsurance. Captives can secure reinsurance to cover risks above certain thresholds, which may lower overall insurance costs. Option C is correct. Captives can use reinsurance to access more affordable coverage, especially for large, unpredictable risks. Option A is incorrect. Captives must comply with state insurance laws, even though they have more flexibility than traditional insurers. Option B is incorrect. While captives can issue policies, they still have to comply with regulations governing insurance companies. Option D is incorrect. While captives offer more control, they are still subject to regulatory oversight. Question 16. What is the term for the process by which a captive insurance company transfers part of its risk to another insurer? A. Fronting. B. Retention. C. Reinsurance. D. Surplus lines. Answer: C. Reinsurance. Explanation: reinsurance is the process by which a captive transfers part of its risk to another insurer, typically to manage its exposure to large or catastrophic claims. This helps the captive manage risk and maintain financial stability. Option C is correct. Reinsurance allows a captive to share risk with another insurer. Option A is incorrect. Fronting involves an agreement with a traditional insurer to issue policies on behalf of the captive, but it is not the same as transferring risk. Option B is incorrect. Retention refers to the amount of risk a captive retains and does not transfer to other insurers. Option D is incorrect. Surplus lines insurance is a market for non-standard risks, not a method of risk transfer. Question 17. What is the primary reason a captive insurance company might decide to reinsure part of its portfolio? A. To increase the premiums it collects from policyholders. B. To reduce its overall exposure to large, unexpected claims. C. To avoid paying taxes on underwriting income. D. To comply with state capital and surplus requirements. Answer: B. To reduce its overall exposure to large, unexpected claims. Explanation: captive insurance companies use reinsurance to reduce their exposure to large or catastrophic losses. Reinsuring part of the risk with another insurer helps manage potential financial volatility and ensures that the captive can cover significant claims without jeopardizing its solvency. Option B is correct. Reinsurance helps captives manage large and unexpected claims by transferring part of the risk. Option is incorrect. Reinsurance does not directly increase premiums collected from policyholders. Option C is incorrect. Reinsurance is used to manage risk, not for tax avoidance. Option D is incorrect. While reinsurance may help a captive manage its capital requirements, the primary reason is risk management. Question 18. Which of the following best describes the concept of captive feasibility? A. A process to determine the financial viability and operational costs of forming a captive insurance company. B. A legal requirement for all captives to operate in a specific jurisdiction. C. A method for distributing risk among multiple captives. D. The process by which captives set aside funds for claims payments. Answer: A. A process to determine the financial viability and operational costs of forming a captive insurance company. Explanation: captive feasibility involves conducting a thorough analysis to determine whether forming a captive insurance company is financially and operationally viable. It evaluates factors such as expected premiums, risk retention, and regulatory requirements. Option A is correct. Captive feasibility assesses whether forming a captive is practical and beneficial for the business. Option B is incorrect. Feasibility is not a legal requirement, but rather an evaluative process. Option C is incorrect. Captive feasibility focuses on the viability of a single captive, not a method for sharing risk between multiple captives. Question 19. Which of the following is a key advantage of forming a captive insurance company? A. Captives can avoid all state and federal insurance regulations. B. Captives allow businesses to tailor insurance coverage to their specific needs. C. Captives eliminate the need for reinsurance. D. Captives are exempt from paying taxes on underwriting profits. Answer: B. Captives allow businesses to tailor insurance coverage to their specific needs. Explanation: one of the primary benefits of forming a captive insurance company is the ability to customize insurance coverage for the specific needs of the parent company. This flexibility helps businesses address risks that may not be well served by the commercial insurance market. Option B is correct. Captives offer tailored coverage that meets the unique needs of the parent company. Option A is incorrect. Captives must comply with state and federal insurance regulations, though they may have more flexibility than traditional insurers. Option C is incorrect. While captives may reduce the need for commercial insurance, reinsurance may still be used to manage risk. Option D is incorrect. Captives are subject to taxes, although they may qualify for tax advantages like the 831(b) election for smaller captives. Question 20. What is a fronting in the context of a captive insurance company? A. The process of a captive issuing policies to cover its own risks. B. The practice of using a commercial insurer to issue policies on behalf of a captive. C. A legal requirement that a captive must front all of its premiums through a third party. D. The act of transferring risks to another captive. Answer: B. The practice of using a commercial insurer to issue policies on behalf of a captive. Explanation: Fronting involves a captive using a traditional insurance company to issue policies on its behalf. The commercial insurer assumes the legal responsibility for the policy, but the captive retains the risks and controls the claims process. Option B is correct. Fronting is when a commercial insurer issues policies on behalf of a captive. Option A is incorrect. Fronting specifically involves the use of a third-party insurer. Option C is incorrect. Fronting is not a requirement, but a strategy used by captives. Option D is incorrect. Transferring risks to another captive is a separate process. Question 21. Which of the following is typically not a reason for a company to form a captive insurance company? A. To retain the risks associated with operating a business. B. To reduce reliance on the commercial insurance market. C. To take advantage of tax benefits related to underwriting profits. D. To avoid purchasing insurance from any commercial insurers. Answer: D. To avoid purchasing insurance from any commercial insurers. Explanation: while captives can reduce reliance on the commercial insurance market, they do not eliminate the need for purchasing insurance. Captives often still buy commercial insurance or reinsurance to cover specific risks. Option D is correct. Captives may not fully eliminate the need for commercial insurance or reinsurance. Option A is incorrect. Captives are specifically created to assume risks and retain coverage. Option B is incorrect. One of the main reasons for forming a captive is to reduce reliance on commercial insurance. Option C is incorrect. Captives can offer tax advantages under certain conditions, particularly for small captives under the 831(b) election. Question 22. What is the primary difference between a single-parent captive and a group captive? A. A single-parent captive insures the risks of a single entity, while a group captive insures the risks of multiple entities. B. A single-parent captive is only allowed to insure the parent company's risks, while a group captive can insure unrelated companies. C. A group captive must be formed by an existing insurance company, while a single-parent captive is independent. D. A single-parent captive must reinsure all of its risks, while a group captive retains all its risks. Answer A. A single-parent captive insures the risks of a single entity, while a group captive insures the risks of multiple entities. Explanation: a single-parent captive is owned and operated by one company to insure its own risks, while a group captive is owned by multiple businesses and insures the risks of all its members. Option A is correct. The key difference is the number of companies covered: single-parent for one and group for multiple. Option B is incorrect. A single-parent captive can insure the risks of the parent company and its affiliates, not just one company. Option C is incorrect. Both types of captives are independent entities. Group captives do not require an existing insurance company. Option D is incorrect. Neither type of captive is required to reinsure all of its risks. Question 23. What is the term used for a captive insurance company that is established to comply with the regulations of a specific jurisdiction or to meet certain capital requirements? A. Fronting company. B. Micro-captive. C. Shell captive. D. Protected cell captive. Answer: C. Shell captive. Explanation: a shell captive is a captive insurance company that is established primarily for regulatory or legal purposes, often without a significant amount of business activity. It may exist to meet specific capital or regulatory requirements. Option C is correct. A shell captive may be set up for regulatory purposes without much operational activity. Option A is incorrect. Fronting companies are used to issue policies on behalf of captives, not for regulatory compliance. Option B is incorrect. A micro-captive is a smaller captive that qualifies for certain tax benefits. Option D is incorrect. Protected cell captives involve separate cells within a captive structure to segregate risks. Question 24. Which of the following best describes a risk retention group? A group of unrelated companies that form a joint venture to share insurance risks. B. A type of captive that is owned by members of a specific industry or profession to cover their shared risks. C. A commercial insurer that specializes in writing coverage for large companies. D. A type of reinsurance company that assumes risk from captive insurers. Answer: B. A type of captive that is owned by members of a specific industry or profession to cover their shared risks. Explanation: a risk retention group, or RG, is a form of group captive owned by its members, typically from the same industry or profession, to share and manage their collective risks. RIGs are regulated by federal law rather than state insurance regulations. Option B is correct. An RRG is owned by members of the same industry or profession. Option is incorrect. A risk retention group involves related members, not unrelated companies. Option C is incorrect. IGS are not commercial insurers but are captive arrangements. Option D is incorrect. A reinsurance company provides coverage for captives, but IRGA do not primarily function as reinsurers. Question 25. Which of the following is a disadvantage of using a captive insurance company? A. It provides full protection from all regulatory scrutiny. B. It requires significant initial capital investment and operational costs. C. It eliminates the need for reinsurance. D. It makes it impossible to insure certain types of risks. Answer: B. It requires significant initial capital investment and operational costs. Explanation: one of the primary drawbacks of forming a captive insurance company is the high initial capital investment and ongoing operational costs. Establishing and maintaining a captive requires a significant financial commitment, including compliance with regulations and operational management. Option B is correct. The high upfront costs and ongoing expenses are a common disadvantage. Option A is incorrect. Captives are still subject to regulatory scrutiny, though they have more flexibility. Option C is incorrect. Captives may still use reinsurance to manage their risk. Option D is incorrect. Captives can insure a wide range of risks, but certain types of risks, such as illegal activities, are excluded. Question 26. What is the primary role of the captive insurance company's board of directors? A. To manage the day-to-day operations of the captive. B. To oversee the captive's investment portfolio. C. To ensure that the captive adheres to regulatory requirements and acts in the best interest of its members. D. To issue and manage insurance policies for the captive. Answer: C. To ensure that the captive adheres to regulatory requirements and acts in the best interest of its members. Explanation: the board of directors of a captive insurance company is responsible for overseeing the governance of the captive, ensuring that it complies with regulations and that it operates in the best interest of its stakeholders, usually the parent company or group. Option C is correct. The board ensures compliance with regulations and the interests of the members. Option A is incorrect. Day-to-day operations are managed by the captive manager, not the board. Option B is incorrect. While the board may oversee general investment policies, it is typically not directly responsible for managing the captive's investment portfolio, which is handled by investment professionals. Option D is incorrect. The issuance and management of policies are typically handled by the captive's management team, not the board itself. Question 27. What is the primary regulatory advantage of forming a captive insurance company in a jurisdiction with favorable insurance laws? A. The jurisdiction will allow the captive to avoid paying premiums to reinsurance companies. B. The jurisdiction will offer lower taxes and regulatory fees to captives. C. The jurisdiction will make the captive exempt from the need for an actuary. D. The jurisdiction will eliminate the need for the captive to maintain adequate reserves. Answer: B. The jurisdiction will offer low taxes and regulatory fees to captives. Explanation: many jurisdictions, such as Bermuda or the Cayman Islands, offer favorable regulatory and tax environments to captives. These jurisdictions provide tax advantages, low regulatory fees, and potentially more flexible insurance laws, making them attractive for companies seeking to form captives. Option B is correct. Captives often choose jurisdictions based on the tax and regulatory advantages available. Option is incorrect. While captives may reduce reliance on commercial reinsurance, they are not exempt from reinsurance if needed. Option C is incorrect. Actuarial input is often required for captives, especially in terms of pricing and loss reserve estimation. Option D is incorrect. Captives are required to maintain adequate reserves as per regulatory standards, regardless of jurisdiction. Question 20. Which of the following is a characteristic of a micro-captive insurance company? A. It insures only the risks of its parent company. B. It is limited to writing only one line of insurance. C. It can have no more than 50 members. D. It is eligible to elect a special tax status under Section 831(b) of the Internal Revenue Code. Answer: D. It is eligible to elect a special tax status under Section 831(b) of the Internal Revenue Code. Explanation: a micro-captive is a small insurance company that is eligible to elect special tax treatment under Section 831(b), which allows it to be taxed only on investment income and not on its underwriting profits, as long as it has less than $2.8 million in premiums. Option D is correct. Section 831(b) offers favorable tax treatment to small captives that meet the premium limit. Option is incorrect. Micro-captives can insure the risks of the parent and affiliated companies, but the tax advantage applies regardless of the number of risks covered. Option B is incorrect. Micro-captives can write multiple lines of insurance. Option C is incorrect. There is no limit on the number of members in a micro-captive, but the premium amount is what matters for the tax status. Question 29. Which of the following is a common reason a company would form a group captive insurance company? A. To pool resources with other companies to reduce the cost of insurance. B. To ensure full independence from the commercial insurance market. C. To avoid state insurance regulations completely. D. To create a direct competitor to traditional insurance companies. Answer A. To pool resources with other companies to reduce the cost of insurance. Explanation. A group captive is created by multiple companies, often within the same industry, to pool their resources and share the risks and costs of insurance. This allows each member company to benefit from lower insurance premiums and customized coverage. Option A is correct. Group captives allow companies to pool resources, reducing overall insurance costs. Option B is incorrect. While group captives reduce reliance on the commercial market, they do not eliminate it entirely. Option C is incorrect. Group captives still must comply with state and federal insurance regulations. Option D is incorrect. Group captives are not competitors to insurance companies but a means of self-insuring. Question 30. Which of the following is an example of a risk that a captive insurance company might insure? A. Coverage for workers' compensation claims from an unrelated business. B. Coverage for property damage to a third party unrelated to the parent company. C. Liability coverage for a business's own risks, such as environmental or product liability. D. Coverage for the personal property of employees of the parent company. Answer. C. Liability coverage for a business's own risks, such as environmental or product liability. Explanation. A captive insurance company is primarily used to insure the risks of the parent company or its affiliates, such as environmental risks, product liability, and property damage that directly impact the business. Option C is correct. Captives typically cover the parent company's own risks like liability and other business-related exposures. Option A is incorrect. Captives generally insure the parent's own risks, not those of unrelated businesses. Option B is incorrect. Captives do not usually cover third-party risks unless the third party is affiliated with the parent company. Option D is incorrect. Captives may provide coverage for business risks, but not typically for personal employee property.